In 2025, around $325 billion was wiped from the total crypto market capitalization, while at the same time $9 trillion was added to the total market value of US stocks. Those two numbers didn't happen by accident and showed how capital chose to position itself under the same global conditions. This was a year defined by macro pressure, inflation still above target, shifting interest rate expectations, geopolitical tension, and political uncertainty. Every market was exposed to the same forces. What differed was how each system absorbed and translated that pressure. Capital moved toward what felt durable and away from what felt fragile. US stocks benefited from something very specific in 2025: visibility. As rate expectations stabilized and earnings remained strong, investors could once again model future cash flows with confidence. That matters enormously for institutional capital. When future profits can be estimated and discounted with less uncertainty, equities naturally attract large inflows. At the same time, artificial intelligence stopped being a distant promise and became a present reality. AI-linked companies were no longer treated as speculative growth plays, but as foundational infrastructure. This created a powerful narrative that was easy for institutions to justify, scale into, and defend. As a result, massive amounts of capital flowed into US equities, especially large technology firms. Crypto did not share this advantage. Despite improvements in infrastructure and adoption, the broader crypto market still trades primarily as a high volatility risk asset. Even small shifts in sentiment can lead to outsized price moves because of leverage and thinner liquidity. Internal weaknesses amplified the downside. The total crypto market cap includes thousands of tokens with very different fundamentals. When leverage unwinds or confidence fades, weaker assets pull the entire market down. This is how hundreds of billions can be erased without any single technological failure. It's a structural issue, not just a sentiment one. Market structure also played a role. US stocks sit inside a deeply institutionalized system with clear rules and established capital channels. Pension funds, retirement accounts, and asset managers can deploy capital into equities with minimal friction. Crypto, while more accepted than ever, still carries higher regulatory and operational uncertainty for large pools of money. This leads to the critical question: is this bad for crypto? In the short term, it was clearly painful. A significant amount of speculative excess was flushed out. Leverage, hype-driven projects, and short-term narratives were punished. But structurally, this kind of reset is not necessarily unhealthy. What declined in 2025 was not long-term conviction, but speculative activity. Bitcoin adoption is not reversing. Infrastructure continued to mature, and long-term holders largely stayed in place. What disappeared was the assumption that everything labeled crypto deserves capital. This environment actually strengthens Bitcoin's long-term position. It forces differentiation. It makes clear that Bitcoin is not just another risk token, but a monetary asset that survives periods of tightening and stress. While the broader market suffered, Bitcoin continued to separate itself from the excess around it. The real lesson from 2025 is not that crypto failed, but that capital became more selective. Markets demanded durability, credibility, and structure. Stocks offered that in 2025. Most of crypto did not. Bitcoin may still earn that role in the eyes of many, but it does so by enduring moments like this, not by avoiding them. So those two numbers don't signal collapse or victory. They signal a system reallocating trust. That's it for today. Now we wait and see what 2026 reveals. For now, stay curious and stay hodling.